Ladies and gentlemen, welcome to the webinar series for April, which is all about how to analyze your China business. You've incorporated your company in China, and it is time for you to start analyzing your growth prospects and how you're looking to move forward in your China journey. So let's get cracking on this webinar. As we're already on day 3 of this webinar series, again, this is just to get familiar with the audience that's on here today. It's to have an understanding about who's a startup in China and who's an experienced China hand. If you are a startup, it usually means you've been established for a period of 1 to 5 years. If you're an experienced China hand, it would be 5 years and up. It'd be great if you could give me some feedback on who you are and what you do, just so we can get familiar with a little bit with the audience. Now, how the webinar works is that I'm here to educate you. So at any point that you have questions or comments, please do insert them in the chat box, and I will get to them at the Q&A, which will be at the end of today's session. From a technical point of view, we are using Zoom meeting. So please note that if you run into any technical difficulties, please try to log back off the system and then log back in using the same URL. If that happens to me, it usually takes about 90 seconds to 2 minutes for me to reboot and log back in as well. So just bear with me. I will be coming on to finish today's presentation. So let's get cracking. Just a little bit about myself. My name is Christina Kohler-Colucci. I'm the head of business advisory at Woodburn Accountants and Advisors. I've been 17 years on the Chinese market based out of Shanghai, and I've been helping companies with their corporate compliance and administrative functions with their companies that they have in China as well as in Hong Kong. I've helped over 500 companies with their pre-investment advisory, their incorporations, and something that I'm enjoying more and more now is the focus on growth in the Chinese market. And that leads me on to today's presentation, which is all about how to analyze your financial management reports in China. So this is a very difficult webinar or presentation to create because every company in China is on their own journey. They might have a varying business scope related to the functions and activities that they're doing in China. So what I've done is try to look at typical weaknesses that we see when we are doing internal audits at companies in China. We focus predominantly on foreign invested companies that are operating in the Chinese market. And so either the management roles are held by foreign investors, i.e. foreign managers, but they would be doing the in-house, they would be doing the accounting work and accounting functions in-house, all right? The idea is to give very simple examples of where things can go wrong, where misunderstandings exist, where communication points can go awry when dealing with your finance team in China. Now, just to note, most likely in SME organizations, so if you're in your startup phase or if you've been longer term in the market, you will have local Chinese accountants in your finance team, all right? Now, while the level of education in China is improving, and while Chinese accountants are getting smarter and thinking outside of the box, there are still regulations that they need to follow in regards to PRC GAAP, in regards to Chinese tax laws, where the misunderstandings then lie, okay? So it is up to the foreign investors, foreign managers to gain a certain level of education on how accounting works in China, which obviously then leads you to having 2 sets of books, because one set will be based on Fapiao accounting. I call it Fapiao accounting because that is actually what differentiates China with the rest of the markets and jurisdictions out there. And then you'll have one based on traditional accrual accounting. So, you know, if you are a foreign invested company, it will be the norm that you have 2 sets of books. One which will be very much based on a tax reporting function, which is on Fapiao accounting, and one which will show you a true reflection of your business, which is based on accrual accounting. Now, in the past and historically, because of high profits tax rates, high levels of VAT rates, companies would basically skim the books. And what that just means is not truly booking in the reality of the business. So it could be underreporting sales, it could be underreporting headcount, it could be a variety of things that we will pinpoint today as to the typical weaknesses. What I want everybody to realize is that with OECD regulations, with the fact that collaborating with banks is becoming more and more difficult because of compliance procedures and documents that have to be filled, there is no more of this tax evasion concept. And I want people to really get this into their mind. We can create structures to optimize your tax situation in China, but taxes have to be paid. All right. There's no more skimming off the books. And I think as a startup in China, as well as a well-established company in China, you need to have reporting that shows the true reflection of your business. Otherwise, how do you have the ability to make decisions and move forward with your organization? All right. There are severe penalties if you are caught evading taxes, whether that might be penalties, whether that might be basically being taken to jail because it's considered as a criminal activity. A variety of things that can happen to you. And it varies in severe penalty and just regular penalties that, might be warning signs that are provided to you, all right? What I want people to be aware of, especially in today's trend that I'm seeing, is that people are looking for investors. People are looking to be acquired. If you are looking for investors and you're looking to be acquired, the one thing that companies or individuals are going to look at are your financials, and they will want to know what is the true reflection of your business in order to be able to invest or acquire you. All right. And if they can't see that in your financials, then most likely they will go somewhere else. So to start off today's presentation, why analyze your accounts, right? What is the purpose of analyzing your financials? Well, one is the manipulation of financial information, right? People are manipulating their financial statements to make it seem that they are doing better than they really are. Again, this doesn't show a true reflection of your organization, right? So you need to be able to analyze your financial information and check whether your accountants are manipulating something, whether they've been told to manipulate something through the sales department, whatever it might be. Bribery and corruption happens on a global scale, not just in China. It happens in South America, it happens in India, it happens in Russia, it happens in the US, it happens in the UK, it happens everywhere, all right? And it's just something that you need to be aware of, and you need to be able to analyze your accounts to make sure that it's not happening within your own organization. Common factors that we see are fabrication of documents, as well as the collusion with third parties. So for example, you are negotiating a lease agreement and your landlord is saying, I will declare a lower lease amount, but then you pay me the remaining amount in cash so that your tax invoice is less, right? That's a collusion with your landlord, basically. You're fabricating the authentic documents that are going to be booked in your accounts and then paying things on the side with cash. You don't want that to happen, all right? You want to be aware of what is going on within your organization. So how are you going to be able to find all of these weaknesses out within your company? And basically, it's doing a variety of different types of due diligences or internal audits. And that's how we find out information. And that's what I base today's presentation on, is when we do financial due diligences on companies, we are investigating where there are weaknesses in the accounts, basically, in the P&L, in the balance sheet, in the cash flow statement. And we're always corroborating this with documentation and paperwork, okay? So China is a country that loves paperwork. There's a lot of documents that have to be filed in terms of vouchering, in terms of fapiaos, in terms of contracts, whatever it might be. you always have to make sure the paperwork is substantiating what is being recorded in your financial statements, all right? There are other forms of due diligence that need to be taken into account as well, right? Legal due diligence. Are all your contracts in place? Are your contracts up to date? Are you at risk in terms of any lawsuits? As we were reflecting in yesterday's presentation about the foreign investment law, have you reviewed your articles of association to make sure you're updated to the new standards that are required against the foreign investment law? Human resource due diligence is also critical, right? One of the things that we discovered doing a accounting and human resource due diligence, because it kind of comes hand in hand when you're evaluating the payroll, was the fact that a company had actually lowered their employees' salary levels due to lack of sales being generated by those salespeople. Now, you cannot lower an employee's base salary for that reason. During COVID, there was an economic global crisis that allowed you to be able to lower base salary levels. But if it's just purely because employees are not reaching their KPIs, that is not a legal valid reason for lowering somebody's salary. You can lower the commission rates, right, and bonus rates, but not the base salary. It's also making sure that your employment contracts are valid, up to date, that there is documentation proving that salary increases are being provided, or that work responsibilities are being lowered, right? So it's doing that form of due diligence. And the other one is doing an operational due diligence, right? It's looking at your business model, your prospects, and identifying whether you are efficient, whether your processes and systems that are placed are efficient. One of the weaknesses that I'm going to highlight is regarding accounts receivables and the fact that sales are underreported because potentially sales are being generated in cash, right? So it's having systems in place and operational guidelines in place that dictate things that will relate eventually to your financials, right? So when I'm looking at over the board compliance, it's just simply, do you have a guideline on providing discounts to customers? Do your salespeople know what those guidelines are in relation to those discounts? I'm not a believer in getting cash payments. Things should be done properly and ethically within your organization. If you're getting cash payments, at least that FAPIAs are issued and those are recorded, okay? But it's making sure that everything is above board and making sure you've got these operational guidelines in place, that your staff and your employees know how to operate and they know what is considered ethical, proper, above board, and what isn't. Okay, so it's looking at these four areas that I just want to reiterate again. It's doing a financial due diligence, it's doing a legal due diligence, it's the human resource due diligence aspect, and it's also the operational due diligence. So where should your focus be placed when you're doing a financial analysis, right? So when you're doing an analysis on your company and you're looking at the financial analysis, it is a due diligence, okay? You are going to be investigating every single line item on your P&L and on your balance sheet to make sure that that is the true value of your organization. In order to do that, like I said in my introduction, is the fact that you will probably have two sets of books. I have two sets of books, right? One which is based on the Chinese financial reporting practices, and one that is based on the international reporting practices, right? So to put it in simple terms, one that is based on FAPIAO accounting and one that is based on accrual accounting, which shows them the true reflection of your business up to date, okay? In terms of the Chinese financial reporting practices, you know, your fiscal year begins on January 1st. You're looking at a 12-month calendar year as your fiscal year. Profits tax is paid quarterly, so your financial reports need to be generated on a quarterly basis for the profits tax, but they also need to be generated on a monthly basis if you're a general VAT taxpayer, because VAT is paid on a monthly basis, right? As well as any other additional taxes that would be associated with VAT, like consumption tax or surtax, all right? The accounting practice in China is based on FAPIAOs. So everything to do with VAT invoicing, right? You book things based on your FAPIAs and when your FAPIAs are actually issued. And there can be differentiations between receiving overseas payments. There can be differentiations, or when I say differentiations, I mean system processes of how to book things. If you're receiving an overseas payment, so you're not going to issue a FAPIA to that overseas company, and then issuing FAPIAs on the domestic market, right? And there will be company policies that you generate as to whether you issue a FAPIA up front, whether you wait for payment and then you issue the FAPIA, which is why there's a lot of misconception that people think that the Chinese reporting practice is based on cash accounting. It's not. It's based on FAPIA accounting. It's based on when you decide to issue your FAPIAs to your customers, okay? And I just want to highlight that as really the biggest difference between Western practices in terms of accounting, which is why we base a lot of things, or why companies have these two sets of books, because, you know, we understand things better with an accrual-based accounting method versus a FAPIA-based accounting method. One situation that arose with me last year was the fact that a client was in dire straits. It took a long time for him to settle our payment. And as a consequence, in 2020, I have no invoices booked for that client because he paid everything in January 2021. FAPIA was issued in January 2021, and it's booked in January 2021. But in my accrual, it shows that I've invoiced him throughout 2020 and that those sales are allocated in the year of 2020. So that's just a simple concept I want people to understand about the two separations between the Chinese financial reporting practice and the Western reporting practice, all right? So to start off with, to give you an insight of what I will be looking at in today's presentation. And again, it's very hard to create this because what I wanted to do was generalize it, which is not always great, but it's hard to go into very specific details on a 90-minute webinar, all right? So I focused on the general mistakes, I prefer to call them weaknesses, that we've seen in the balance sheets and in the income statements. We're going to look at an example of a balance sheet and a P&L, and I will show you how we analyze those to show you that actually in the end, what happens, okay? I hope you'll get a bit of an understanding out of all of this. I always feel that if I don't have finance people on here, it can always get a bit tricky to understand these concepts. If you guys have any questions, please raise them. I'll try and do my best to answer them. If you guys want to have just a one-to-one about your current situation, we can do that as well, all right? But what we'll be looking at is items in the balance sheet, items in the income statement. So the first item we're going to look at is the accounts receivable, all right? And basically there are two weaknesses that we see. One is that many businesses have the inability to prepare an accounts receivable aging analysis because of poor communication between the sales department and the financial department. Communication is a fundamental concept that people need to be aware of, okay? If you are in the habit of issuing a debit note or issuing just a normal invoice to your customers in order to be able to receive payment and then issue the FAPIA, you need to have your accounting team prepare a separate accounts receivable aging analysis to know when that initial invoice was actually issued. Because the accounting department will normally only follow when FAPIAs have to be issued. So they will not know what is the trend prior to those FAPIAs being issued. And if the sales departments and financial departments don't communicate, there is no, you've got to imagine your financial department is basically sitting there not knowing at all what is going on in the business, okay? So communication is fundamental. The sales department should be talking to the financial department on a weekly basis to know what sales have been generated so that the financial department knows what FAPIAs will have to be issued based on the payment terms of those initial invoices that have been issued. And it is wise for the financial department to then create an AR aging analysis so that the sales department has a guideline of how to follow up on payments. okay? Now, obviously, if you're issuing FAPIAOs up front, the AR aging analysis is going to be easy because the FAPIAOs are in the system. The AR is going to be produced from the system based on those FAPIAOs being issued. And again, this is all based up to you because it's a FAPIAO accounting method, right? So it's, do you issue the FAPIAOs up front and therefore it's all in your accounting software system, or do you issue the FAPIAOs upon payment? At which point then you're going to do an accrual basis accounts receivable aging analysis, right? So communication is key, and understanding how you're actually implementing that process of the FAPIAOs is critical. It is also common practice for businesses to attempt to hide sales to reduce taxable income, right? And as such, the accounts receivable is underreported, okay? Now, this then leads to other issues. If you are hiding sales, it's very difficult to hide inventory. And if those two don't match, then you're also going to get into difficulties later on, right? So just because your sales department is hiding sales doesn't mean that your warehouse management system isn't going to be recording the ins and outs of your inventory, right? If you're going to be hiding things, then make sure that it's following in the supply chain, all right? Which I don't recommend. I'm not here to say that you should or suggest that you should be doing that. It's just that this is what we're seeing, is that if you're going to hide sales, make sure that you're also hiding the inventory associated with those sales, all right? And that's where then people aren't thinking, and that's where they get caught out, all right? So yeah, it's true. Hiding sales can reduce your taxable income. For instance, for us, if I realize that we're generating too much profit in a quarter period, and I don't want to pay so much taxes because maybe I have cash flow issues, I may issue my FAPIAOs in the first 2 or 3 days of the following month, which would then be in the following quarter period, in order to underreport my accounts receivable. But I do know that eventually when I look at my year end, it will all be consolidated, okay? So yeah, I am guilty of doing that, but I also know I'm doing it for a quarterly period. It's going to be booked into the following quarter. And if I can't then lower my taxes in that quarter period, I'll just have to incur that liability, okay? And I know that by the year end, everything will be recorded properly. So I wouldn't have underreported. I'm just moving things into other quarter periods. But do analyze that within your organization. Are people hiding sales? Obviously with service, it's easier to hide because then you just get cash payments. If you're actually hiding sales in terms of product, much more difficult because you also have to then look at the inventory. Let's look at the other accounts receivable. So typical weaknesses with the other accounts receivables is that many times there are irrelevant transactions that are recorded in the other accounts receivable account. So for example, internal loans between two related companies, right? So you may have asked for a local loan and it's recorded in the other accounts receivable. It's not listed as a transaction in the investment account, okay? Loans are a very complex concept in China. You have special bank accounts where loans should be put into. And then through that bank account, it gets recorded in the investment account, okay? So again, this just comes with the knowledge level and experience level of the accountant that you have, knowing that as a foreign invested company, loans have to be recorded within the investment account and not within other accounts receivables, all right? Looking at fixed assets. So I will go into much greater detail on this in the actual example on the balance sheet to show you 4 areas where people get things wrong in relation to fixed assets, okay? Many times with startups, they don't include fixed assets into the fixed asset list, into the fixed asset chart of account, okay? Which means that depreciation is not occurring. And basically what they've done is they've recorded it as a cost in the expenses, okay? Now, the result of that is that it just becomes an expense item. If you then start growing, so I'll give you an example. let's use laptops as an example. You're starting up your business, okay? You have yourself, probably you've purchased your computer on your own. You're not gonna bill that to the company. And you now have hired your first employee, and you decide, or your accountant or whomever decides with that first employee, the computer is just going to be booked as a cost in the expenses. It's going to be deducted for that quarterly period, and it's not going to be considered as a fixed asset. The issue arises eventually as you grow, and suddenly you've got an office where you've got 25 computers sitting there, they're visible, there is a massive printer, and none of those items are booked in your fixed asset list. And then you've got investors coming in, or you've got a company that's looking to acquire you. And they go in your office and they start counting because they're doing their due diligence. You've got your 25 computers. Why is this not booked into the fixed asset list? And obviously, as you start getting into growing your business to the point where you've got equipment to trade, you've got equipment to produce, and initially you were paying these off in cash, maybe not even getting FAPIAs for them, meaning they're not even booked in the company expenses at all, right? How are you going to explain that to investors or people that are looking to acquire your business, right? Every little detail counts. And I just want to highlight how valuable that information is, because when you're in the startup period, these little things, they're not going to matter to you, you know, and it probably won't even become a discussion point with your accountant. Okay. They should become discussion points, because you don't know how quickly your business is going to grow. You don't know how things are going to be evaluated. And can I also just say, if you do have a fixed asset list, make sure you're updating it. So as you're going through the depreciation process, you know, equipment, I believe, is at a 5-year term. Make sure it gets released out of your fixed asset list. Okay, it's removed. The fixed asset list needs to be updated. Generally, another weakness that we see is that accountants are happy to put things in. Accountants don't follow up with it, don't remove things, don't update things. Okay, and it is vital that you do that with your fixed asset list. The other is construction and process. And obviously this is going to be related to companies that are building manufacturing facilities or even are in manufacturing processes. So again, here it's that the fixed assets are not recorded in the construction and process, nor are they later transferred into the fixed asset list. And ultimately in China, Chinese companies do not like to provide documentation for anything. And the big negotiation aspect is the fact that they will say, we will give you a discounted price as long as we don't have to give you a FAPIA and you pay us in cash, right? And you do it because you're like, yeah, I'll go for that discounted price by all means, but you're not thinking about the repercussions and the consequences of not having original supporting documents related to those fixed asset items, okay? So it's the same with computers. A big mistake with computers, with printers, if you start buying cameras for your office, any small instruments or equipment that you're using in your trading function, these all can lead to not having original documents. So actually proving that you don't have anything, but actually these are critical assets supporting your business. And then you don't even have the original supporting documents, contracts, purchase orders, or FAPIAs related to them, okay? So in regards to fixed assets, as well as construction and process, please make sure that you've got the documents, you've got the VAT invoices supporting them, and you're booking them in the right accounts, and you're not trying to hide them or putting them into your expense accounts, and then they're forgotten, all right? Looking at accounts payable. So again, in terms of accounts payable, you need to have specific guidelines in place to know, or let me start from the beginning. You need to have a discussion with your accountant to know what the definitions of all these items are. And again, I'll go through this in detail when we look at the balance sheet and the P&L. But you need to be able to define with your accountant what is an accounts payable. okay? You need to know what is booked in the accounts payables and what is an irrelevant transaction and what is a relevant transaction to your accounts payable, okay? And this then leads me on to other payables. In terms of other payables, it's the same situation with the accounts receivable. You maybe don't have the ability to issue an aging analysis, or there's a lack of communication between your merchandising department and your financial department. Similar as with your sales department and your financial department. All of these departments need to have a level of communication that exists so that the accounting team knows what's going on. They're usually the last people to know anything, but they need to be able to prep any and all situations, okay? And the merchandising department, more importantly, has to also define to the financial department what are the payment terms, right? So that aging analyses can be created. So you know when that first invoice was provided. Now, the issue is that many suppliers in China do not provide supporting documentation. And this is where you've got to start pushing them to get the relevant documents so that your company has a true reflection of what is going on, okay? And you need to decide who does that follow-up work. Is it your merchandising department or is it your financial department to get that documentation? There's no right or wrong answer with the communication aspect. It's just a matter of how you want to develop that internally within your organization to make sure you've got the right documents in place and that everybody is knowing what's going on, all right? Now, it's also common practice to hide costs or that kickbacks are generated in the merchandising department or the sourcing department or whatever you want to call that department, right? Very common to have kickbacks, very common to know that negotiations are happening with the idea of kickbacks in mind. So again, this is where your financial team comes into play, right? There should be some sort of understanding of pricing, common pricing, market pricing in relation to the suppliers that you're working with, right? Your finance team will and should know this type of information so that they can see whether you're being undercharged or overcharged with your suppliers, okay? Don't underestimate the abilities of your finance team to be able to find that information out for you. Use them to your advantage. That's what they are there for. The finance team actually, when used properly, will be doing this due diligence on a daily basis to make sure that your departments are doing things above par. Obviously, if they find something out, they report it to the manager. It's the manager's responsibility to declare that something is not right and there's a huge red flag in the books, okay? So you need to be aware of that in terms of the accounts payable. Payroll payable is also something very interesting. So, and this happens again quite often because of the lack of knowledge about how payroll is structured in China. So it could be the following. Generally speaking, you need the month to end. So let's take somebody's salary, right? So let's say somebody is earning 30,000 RMB. Gross part of that is going to be social insurance. So let's say that goes up to 35,000 RMB as a total payable by the company. If you're managing the whole social insurance under your own organization, as well as the housing fund, plus you're paying the net salaries, you're not using an intermediary payroll agent, what you will discover is that you will choose the last day of every month, so let's say the 28th, 29th, 30th, 31st, to pay the net salaries to the employees. Then you will discover that the Labor Bureau will issue the final social insurance rates for that month in the first 3 days of the following month. So actually social insurance is not booked into the month of where the payment is actually made, it's booked into the following month. Now in this regard, what we recommend companies to do is to actually do this on an accrual basis. So you want every month the salaries to be booked. Otherwise, your accounts look extremely confusing to the tax bureaus, to yourself. And I'm talking about this in terms of Chinese financial reporting. So accrual can still occur under Fapiao accounting, all right? And how it works with payroll is that you know that this is a standard payable every single month. Slight differences will occur if you increase salaries, if commissions are made, or if social insurance rates change. But ultimately, you can still accrue these figures at the end of each month, even though some of the payments will occur at the start of the following month, like the social insurance amount that you might not have control over. So you still accrue it in the previous month, even though the payment was the following month. I hope I'm making that clear, guys. If you're struggling with that, let me know. But let's say we use the month of April. We are now paying net salaries to our employees. That's being booked. And we are also booking the social insurance amounts, even though that money will be exiting my account in the first 3 to 5 days of the following month. Okay, but I'm still booking it in the month of April. So again, this is a typical weakness that we see with, again, accountants that don't have that knowledge level and experience level that accrual can work in China, is that for payroll, you can book it all into that 1 month. And, you know, it gets very messy when you're starting to do it in different month-end periods, okay? If you have a knowledge level that you know net salaries are paid at the end of the month, social insurances are paid at the start of the following month, and you accept that and you can read that from your financial reports, then by all means keep it as is, as the status quo, as long as you are aware of that happening. Okay. Otherwise, accrue and keep all the payroll functions in that month. Sales income. All right. So here are again issues that arise in terms of P&L. Okay. So company management does not record all the sales revenue in the financial statements prepared for the tax bureau. Okay. For example, for some cash sales, the company will not include them in the financial statements, but will maintain them in an internal sales book. Okay. Meaning they are not recording the cash that you are receiving. It's not recognized in the books at all. But the issue comes down then with inventory, especially if you are selling products, right? Service will be more difficult to prove, right? And like I said, in my situation, I follow point B often, which is sometimes the sales will be delayed and recognized in the following quarter period in order to be able to lower the profits tax. Okay, so that does happen quite often. Costs of goods or services sold, typical weaknesses. In many cases, businesses do not adopt a sound cost carrying forward method to record and allocate costs. And often businesses will record irrelevant items in the cost of goods sold and record it in the cost of goods sold instead of in the fixed assets. Okay. Again, this comes down with defining what cost of goods sold is and defining what cost of services is. In a service company, if you have a team of people that are actually doing service delivery, their salaries should actually be allocated into the cost of service, not as headcount, right? So these are slight differences that you can create in order to, again, have a true reflection of your business. And you've got to understand what the definition of those are, and your accounting team should be sitting with you that everybody has a clear definition of what costs of goods sold are. Another issue that arises is that when you start hiring and building your finance team and you start hiring lower end accountants, so cashiers or junior accountants, they need to be trained on the definitions that you have set for what income means, what cost of goods sold mean, what goes into fixed assets, because they generally, these junior accountants are doing the actual typing and bookkeeping into the general ledgers. Okay, they're getting the documentation, they're reviewing it, and it's up to them then to decide where does it get allocated. Okay, so definitions are fundamental that everybody should be knowing what goes into cost of goods, how should be calculated, etc. You know, one thing, again, just as an example to highlight is At Woodburn, we've got annual fees. Some of those annual fees are actually recurrent over a 12-month period. And we split that income into then the following 12 months to allocate it accordingly. We don't put it as a lump sum into 1 month. And this is something that you can do. You just need to make sure that it is defined properly to your accountant and it's defined properly to the people within your organization so they're aware of it. Expenses. Now, expenses are critical, okay? There is this confusion of what is an expense and where should it be booked? Should it be booked into expenses or should it be booked into the fixed assets, right? Sometimes they're not put into fixed assets, they are put into the expense and vice versa, okay? Again, this comes down to definition, because what will happen at the end of the year is that the auditor will review your expenses, try to do breakdowns into them, and then at some point will say, listen, that's not a fixed asset, that needs to go into your expense, and they will reverse the bookings, okay? So again, definitions are critical, knowing what goes into fixed assets, what goes into expenses. The other weakness that we see a lot is that there are certain expenses where you get additional deductions and taxes, and sometimes you've exceeded those limitations, but you've still put them as part of the tax deductions. So you need to be aware of what those limitations are. You need to know when you exceed those. Your accountants should be highlighting that and saying we've exceeded it. Do we need to readjust or not based on what's happening down the line in the next few months? And know how this will impact then your profits tax in China. So for example, R&D is one area. Marketing and advertising is another area. So you need to be aware of those. Income tax. So again, most companies underreport. And as a result, income tax will be underreported as well, which ultimately leads to your P&L usually showing a loss at the end of the financial year. Now, if you start working your financials in this method and you don't keep a second set of books, you will never know, first of all, are you doing things properly? Does the tax bureau have suspicions over us? At what point should we be doing things properly so that we avoid suspicions from the tax bureau? You will get lost because the accounts are not showing a true reflection of your business. If you do keep an accrual set of books and you do know what is the true reflection of your business, you need to start tax planning. And you need to know at what point you need to start making money in China to avoid suspicion with the tax bureaus. We are all trying to create tax optimized structures in China. All of us, we're trying to lower our taxes in China. We're also trying to lower our taxes in our home jurisdictions, right? It's a normal behavior. What we don't want to do is evade taxes though, because taxes have to be paid. And what we don't want to incur is our name being put on a blacklist or having penalties to incur, or ultimately having to go through lawsuits and ultimately facing criminal time, right? So tax planning is critical. You need to be smart on how you are optimizing your taxes in China, how things are being structured, how this can impact you in the future, and then creating a phased journey where at some point you do pay taxes in China in order to make sure you keep yourself under the radar. There are always ways of developing profit repatriation strategies, whether it's through licensing agreements, royalty fees, whatever it might be, but those are valid and true contracts, right? If your trademark has been registered in China and it's been registered by your company in your home jurisdiction, it is valid that you ask for a licensing fee, all right? Because it's being used in the Chinese market. It's just a legal method for you to also then repatriate funds back to your home jurisdiction, okay? So obviously your income tax will be lower because of that, but it is a true and valid transaction. If you are hiding things, in your business, then that just only leads to one thing, which is potential reporting. And I just want to highlight also the fact of the following. When you set up your company in China, you register yourself with your district tax bureau. It is ultimately the accountant who is communicating with the tax bureau. He or she also registers themselves, not under your company, but registers themselves with their own accounting license with the tax bureau. So they're going to take on a certain liability in relation to the information that is being passed on to the tax officer. So, if they are okay and fine with hiding things and doing things in a certain way, by all means, they can. It's going to be a risk for your company, though, and they're going to take that own risk personally. When you're outsourcing to a provider, they will not accept this risk because they will not risk their own accountants to put in fake information to the tax bureaus, okay? And if red flags are being shown, most outsourced providers will expect the managers to come back and give explanations and realize that they're doing something wrong, okay? And this comes in the shape of underreporting salaries, underreporting sales income, putting in too many expenses, etc. Okay, so you need to be aware of this. So we're going to now look at a balance sheet statement and a profit and loss statement. And what I've done is I've put notes where I want to highlight important aspects to these balance sheets and P&Ls. Okay, so this example is just a foreign invested company in Shanghai. I've made up the numbers to show what I'm trying to explain as the types of weaknesses that exist. The company records and the company records and maintains a set of financial statements which are prepared for tax purposes, i.e. Payroll accounting. Okay. They also maintain an incomplete internal financial data prepared in let's just say it's accrual statements that are prepared. And they're incomplete because of the lack of communication that is occurring between the various departments, okay? The local management does not prepare complete and accurate cost information. Why don't they do that? Because that is not their priority. Their priority as local managers is to focus on the core functions of the business, and their focus is not to look and analyze at the financial statements. So let us look at this balance sheet, okay? Again, what I want you guys to look at is that you've got the current assets, fixed assets, total assets, current liability, long-term liabilities. And what I want everybody to know is that you need to have definitions yourself internally about what this all means. What is booked under these items, okay? Cash and bank is easy. That is based on bank statements. But how are accounts receivables booked? How are other receivables booked, okay? How are you checking inventory? What system do you have in place to check inventory? Prepaid expenses, total, you've got to have definitions for all of this, okay? So while looking at this balance sheet comparison, we've got a column which is original. So that is what was prepared and reported to the tax bureau, and what was revised based on the due diligence that occurred within the company, okay? Working documents that were utilized for that due diligence were a list of documents we asked in terms of contracts, in terms of debit notes, invoices, FAPIAs, inventory, warehouse management, inventory systems, etc. Okay, so we asked for a whole compilation of documents so that when we arrived at their office, we would go through these things one by one. Okay, so in regards to note 1, which is in relation to the accounts receivable, there is a ginormous difference here from 6,839,000 renminbi to 18 million renminbi. Okay, why is that? Well, number one, the company is not disclosing all the accounts receivables in their financial statements to the tax bureau due to the underreporting of the sales revenue. Okay. And in another area, the reconciliation between the company and its customers is not conducted in a timely manner, meaning that in terms of reconciliation, that is issuing the FAPIAs, getting payment on time based on the terms and conditions of the payment terms and conditions. And as a consequence, there is this ginormous variation, okay? Involved in all of that is the lack of communication between the finance team and the sales team in regards to what is being generated, okay? So please be aware, accounts receivable is something that happens often, okay? And just a simple step forward would be to develop that communication, instigate weekly meetings, do it every single Friday. Sales team, finance team have to sit together about what sales was generated in that week, right? So that they are up to speed and that they can then create AR aging analyses, that they also dictate who is going to be the follow-up with the client in terms of payment, okay? Note 2 is in relation to other receivables. Now, the amount has remained the same, as you can see, but certain key transactions have been recorded in the other receivables, okay? And these transactions are questionable, meaning that they need to be investigated properly. So other receivables as well as other payables are always two areas that we investigate thoroughly, transaction by transaction, to understand exactly what has been booked in those. Does it fit into the other receivables or other payables definition? In this situation, the amounts have remained the same, but I've highlighted it as a note because I want people to realize that that is something that they have to investigate consistently to know what the details are underneath them. Note 3 is in relation to inventory. Okay, in relation to inventory, there are two things that have happened in this situation where one, the company has no software system. So everything is done manually, okay? Meaning that they also are having difficulty to accurately follow the inventory movements, inventory out, inventory in, okay? And this has caused, because of this manual manipulation, this has caused variances between the actual stock and the book figures, okay? Another thing that you have to realize with inventory is that physical inventory counting has to happen in order to make sure that the stock figure is accurate, okay? Whether you do that on a monthly basis, whether you do that biannually, whether at a minimum you do it at year end, so that you know year end, 31st of December, what is your stock count, and you can then readjust your books, is critical, okay? Whether you outsource that inventory check, whether you decide to do it in-house, completely up to you, but make sure you're doing that. Now, if you have a logistics provider and you are outsourcing the warehousing functions to a logistics provider, they will be utilizing a warehouse management system. It is up to you to be able to introduce your finance team and your warehouse management team so that either on a weekly basis, bi-monthly, monthly basis, stock check is done, or at least a printout from the warehouse management system is provided to the finance team. Okay. In terms of fixed assets, which is note number 4, again, that's quite a big difference there, okay, in relation, about 12,000 RMB in relation to the original and the revised, okay? So here is where weaknesses happen in terms of fixed assets. One is that the company is a manufacturing entity, and assets should be mentioned that some equipment is made by the company and some are purchased by outside vendors, okay? So you need to show what has been produced as a fixed asset internally and what has been purchased by a vendor. Okay. Then you've got VAT implications. VAT related to fixed assets purchased cannot be deducted from the current period's input VAT. So you also need to analyze, when you are purchasing any forms of fixed asset, the VAT consequence of that and how that is actually being booked as well. Okay. Corporate income tax implications are also critical. So recording the fixed assets into the expense account instead of amortizing them as fixed assets will deduct more expenses in the current period, obviously, and allow the company to underpay the corporate income tax. But it doesn't show a true reflection of what is happening, right? So as a consequence, the auditor at the end of the year, if they're really doing a proper analytical due diligence, will reverse that, okay? Which means you may be paying the same taxes by the end of the year anyhow, all right? And the fourth is the most common, which is that when you are purchasing fixed assets, your vendors or suppliers will not be issuing VAT invoices or any form of supporting documentation. And as a consequence, you're not booking them. So you've got to make sure that you're not going the cheap route. You are actually paying for your fixed assets and you're getting the original documentation back from your vendors and your suppliers. Note 5 is in relation to the accounts payable. So it's very similar to the accounts receivable. The accounts payable is not being checked thoroughly, right? They've got an internal record of what's happening in terms of accounts payable, but it's not being booked accordingly, right? So transaction accounts such as AR, accounts receivable, accounts payable, other receivables, other payables need to be noted very, very carefully, okay? In note 6, other payables. So in this situation, what happened was there was an internal loan that was created. The company management reduced the end balance of the other payables by 3.96 million. The amount is part of their intercompany liability, and the reduced 9 million was recorded in the debit of the capital reserve account. Okay, so if you look at capital reserve account, that is the adjustment that was made when we were doing the revised due diligence. Okay, so it's again the accountant not knowing where things should actually be booked. Okay, note 7 is in relation to the accrued payroll. So here again, it's the postponement of postponement of paying salaries to staff, as well as errors in the calculation of the welfare and social insurance that needs to be paid to the employees. Okay, so again, we want people to be aware and investigate the accrued payroll and the welfare payable. All right. In terms of note number 8, which is the welfare payable, it's the same thing. It's again, knowing what adjustments have to be made if rates change and making sure you're calculating things properly. Note 9 is the tax payable. So in some cases, the company does not issue VAT invoices to customers, or they don't issue those VAT invoices in time, or like us, we put it in the following quarter period so that we can lower our income tax, and as a result, the VAT is underreported. Okay. In terms of note 10, it's in relation to note 6 in terms of not putting in the right loan agreement amount into the reserve, into the capital reserve instead of the other payable. Now let's look at the income statement comparison. Okay. So again, here you can see in terms of sales revenue, a huge difference, right? So there is 2 possibilities. I mean, this is a very large difference, right? Hopefully we would not be seeing such big differences, but this is just to show you guys what it would look like. So there are 2 possibilities for incorrect ending sales account balances. One is the cutoff issue, right? It's necessary to understand how revenue is recorded in the company as it, again, relates to PRC GAAP standards, right? FAPIAO accounting. At what point are you issuing the FAPIAOs, right? Another is incomplete sales data. And again, that has to do with the communication between the sales team and the finance team. So the company management does not record all the sales revenue in the financial statements prepared for the tax bureau for the purpose of tax evasion. Or it can also be concealing any form of cash sales by not putting them into the financial statements, but maintaining them in an internal sales book only. This is maintaining them into an internal sales book, not even putting them into the accrued version. Okay, it's complete tax evasion. In terms of the cost of sales, again, companies are often, again, there's a very slight difference here, but companies are often not establishing an appropriate cost forwarding method to record the accurate cost, okay? So keep that in mind also in terms of the cost of sales. And number 13, in terms of income tax, it's just the underreporting of the sales revenue, right? Which directly impacts the income tax that you're liable for. So in summary, when you're looking at all the weaknesses that I have highlighted here, it is important for you guys to understand the Chinese financial reporting system, why it's important to do due diligence, why it's important to do verifiable accounting, and why it's important to minimize your risk in China, right? You need to come to that awareness and that realization, all right? What I don't want to end up is that you are at a point where you're looking to gain new investors, or you're looking to acquire, or you're looking to be acquired, and your financial situation is in a dire mess. It is so hard to fix things. And usually that stems from having a junior accountant on board who really has no knowledge and experience level and has nobody to actually bounce ideas off of or discuss things with. There's no definition of the charts of accounts and how things should be booked and where they should be booked. There is just a lack of communication between departments in relation to the finance aspects, because that's not important. What's important are the core functions of the business, which is sales, maybe sourcing, and maybe marketing, right? The points mentioned above are, again, just general levels of introduction to the typical problems we see. There could be very obscure problems that you never even thought of popping up, which is why, again, you should be doing a due diligence and sitting with your accountant on a month-to-month basis to analyze what is going on with your organization and going line item by line item and going into the details, the nitty-gritty details of how things are being booked, okay? The differences in Chinese GAAP protocols together with the standards of Chinese financial reporting versus the Western style of accrual accounting or IFRS is important, okay? If you need both sets of books, which generally I recommend companies to have, you can absolutely have that. That's not a problem. It's just that you need to have proper definitions in place, and you need to have an accounting team there available to know how to do that transfer from the Chinese reporting to whatever reporting that you need in order to understand the true reflection of your Chinese business. Explanations are critical, okay? And what I see generally in the market is that people don't ask for explanations, which sounds ridiculous, but they don't. They take things at face value, okay? Now, like I said, it's not always easy to find the right accountant for your company. And what people also don't realize is you've got to pay to have a good accountant. And I don't mean by outsourcing. I mean, if you want to keep things in-house within your organization, if you want to find a highly qualified accountant, you're going to have to pay for that. We just finished a recruitment process where the final 3 candidates were asking for salary levels gross between 20 and 30,000 RMB. And it was all based on their skill set and their qualifications. The title of the roles, you can call them whatever you want, CFOs, finance managers. They were just local Shanghainese accountants knowing how it works in Shanghai. They had between 15 and 20 years of experience, and those were the salary levels they were asking for. Speaking, by the way, fluent English. Okay, so you've got to pay for that. And with these candidates, one thing that I was noticing and pleasantly surprised with was the proactiveness they had in approaching their managers, or even approaching the foreign CFO based abroad to say, there's a red flag here, or we're lacking an operational guideline. Can we create one so that we can explain things? Or we've got a lack of communication. I don't have access to the sales team and they won't sit with me. Can you help me to generate that discussion? All right. But you need to have qualified accountants on board who are familiar with China, know the mechanisms of what's happening, to give you a true reflection of what's going on in your business. All right. And if you are an investor, you've got to be aware of the risks. One of the biggest things that I get asked by companies incorporating in China is, oh, I'm scared to be in the corporate management. I don't want to be the legal rep. I don't want to be the executive director or the board of directors. And I'm like, well, are you planning on doing something criminal in China? The answer is obviously no, they're not. But they need to understand that usually things are found out through the financials. And if you don't have an appropriate accountant or outsource provider who's taking care of that for you to make sure that you are at least in compliance and doing things above board, and there's no suspicions from the tax bureaus or the banks or anybody, then you have nothing to worry about. But you need to know the risk if you don't have those people on board, okay? And you need to be able to also assess those financial statements. And if you're not, you've got to find the right people who will help you do that, okay? And in the terms of acquisition, having gone through that myself, where in our previous company, we were acquired, and I went through the due diligence process hands-on in relation to that, it is horrible. Even if you're doing things on board, the company that's looking to acquire you is always going to try and negotiate the price of the company. And they're always going to try and find holes in your organization. And the best way to find those holes are through your financials. And they will look at your financial statements from left to right, from up to down, from backwards and forwards to try and find holes in there. It is painful. And you have to provide actually explanations for everything. So it's a good exercise to start the explanations from the start with your qualified accountant to, again, just start the process of being able to explain things, explain your line items. Why is revenue going up? Why is revenue going down? Why are costs of goods or services going up? Why is it going down? What does my fixed asset look like, etc. Right? Because that's painful. That is an extremely painful process. And nothing is going to stop that process from being painful, except if you are on the ball and you can answer every question that's being asked to you, okay? The same applies if you are going into a potential joint venture in China, right? So if you already have an existing entity in China and now you're thinking about expanding and going into a joint venture relationship, both parties are going to be doing their due diligence on you, right? So you need to make sure, again, you've got explanations, you've got reasons. When you're creating your budget, you know what you're basing your budget on, and you know how to formulate those discussions. Okay, so my belief is very much in taking a preventative approach. I like to be systematic. I like to have guidelines in place from the start so that it is easier for everybody to be able to provide explanations. It's also helpful to have these guidelines in place so that if mistakes happen, which they do, everybody is human, improvements can be made to those guidelines to make sure that you're moving in the right direction. So how are you going to tighten your financial controls and have a closer review of transactions, right? You need to make sure that the documentation is there. You have to be able to detect, spot, and deter anything and everything, right? So again, doing due diligences, doing these internal health checks every so often by separate providers is critical to your organization. So reviewing signatures on contracts, are they the right signatures? How are the company chops being utilized? Do you have a logbook of how those company chops are being used? Verifying the authenticity of FAPIAOs. You want to be able to check that the FAPIAOs you are receiving are not fake, that they are true and valid. And there are ways through the Tax Bureau website, as well as by just phoning the hotline, to verify that FOPCAs are authentic. You don't want to be caught up in an audit where you have fake FOPCAs in your books. You want to be able to vet your third parties' corporate information. Okay, so what I mean by that is when you are working with customers, when you are working with suppliers, do your vetting process. If I've just gone through this myself, I'm helping a company to act as their invoicing agent in China, and I've been vetted by their customer in China, and that vetting process took 2 to 3 months, 2.5 months basically, where they vetted us. We had to provide documentation, we had to provide our VAT information, etc. We had forms and questionnaires to fill in. I'm not saying that you have to go through a 2-month vetting process, but vet third parties. Make sure that you are transacting with reputable, maybe even reputable is too big of a word, but companies that are solid and stable, that you don't run into any issues, and make sure that they can provide the valid documentation that you need for your own accounts, right? Whether that's a FOPCA, contract, purchase orders, whatever it might be. Carry out site visits of third parties. So we had that. They came to visit us. It was a 10-minute meeting, but they came to visit that we were real, and that we were, not lying. So carrying out site visits of third parties, identifying if there are false customers, false suppliers, reviewing financial information filed with the authorities, including annual reports. You can do that of the third parties, but also just doing it of yourself, right? Doing checks, make sure your in-house accountants are filing the right things that you want them to file, all right? And yeah, being able to then also review relevant accounting records of third parties that you're transacting with as well, is important. But doing it in-house is critical too. And I'd just like to say, due diligence is not something that should be perceived as something negative for anybody within your organization. It's actually telling your team, we are here to stay, we are moving forward, we are growing. I need to do regular checks to make sure we're in compliance so that all of us can sleep at night and we know we're going in the right direction. Because the last thing that you want to happen to you is that you are denounced by a staff member, a customer, a supplier, that you're not doing something ethical. You don't want to be investigated by a tax bureau. We were. I mean, it was a positive thing because they were investigating us because they said you've got a very high sales revenue compared to other competitors in the market, and we want to investigate why you've got high sales. Are you doing everything above board? And so we were investigated. It was a 6-week process. We had to give documentation, we had to provide contracts, and the one thing that we were missing was just a system guideline of the full journey of a customer, which we then had to create. We now have. We don't use it. It was for the purpose of the tax bureau, but because we have other forms of operational guidelines, which they also saw, but they wanted that. So, even if it's a positive thing that you're being investigated by tax bureau, it was a 6-week process that was at the top of my mind, and I wish it hadn't been. But these things happen. The issue is for us, it took 6 weeks because we had explanations, we had answers, we had documents. It actually flowed relatively quickly in terms of the back and forth communication because we had everything in order. Okay? If you don't have everything in order and you have to start creating stuff, that's not fun. If you want to verify your own books, so for example, if you're a larger organization and your CFO from your home jurisdiction wants to go in and just evaluate and do their own due diligence, what would you need to verify your own company's books? That's actually what I wanted to provide with you, is what should they be looking at, okay? So the first thing is in terms of suppliers, verifying the proper contracts are signed with suppliers, verifying the corresponding VAT FOPCAs and making sure that they are there. In terms of clients, it's again, are proper contracts signed by the clients, and are there corresponding VAT FOPCAs with those clients, and does it match? Okay. Again, this all doesn't sound very complicated, but in many instances, and especially with WeChat, we're running into issues where Verbal commitments are considered, or verbal or text commitments are considered contracts. They are not in the legal sphere. So you do need to have these documents in place. When you're looking at fixed costs, right? So for example, rental contracts, have they been signed? Are they updated? Are you verifying your insurances? Have you looked at all of your equipment in terms of computers, printers? Do you have the corresponding FAPIAs and contracts in place? You need to make sure that for every piece of equipment or anything that is booked in the fixed cost list, that you know you have the supporting documents available. When you're looking at human resources, verifying employment contracts. So we have, because I don't want to do this, we have open-ended contracts with our clients, with our staff. And if there is a salary increase, we have a resolution that is issued, just a letter to say you've received an increase, and we put it in each employee's file. But it just means that I never have to redo an employment contract or think about an employment contract. For those of you that are working on fixed term contracts with your employees, you need to make sure that you have the follow-up contracts, right? So I have some clients that start off with just 1-year term contracts and then forget, they'll do a verbal commitment to renew, but they won't have an employment contract signed for the next term. Okay, you've got to make sure those are there. And don't realize the penalties that exist if you don't have it there. The penalties are based on daily salary rates for not having the contract there. Verifying that the employees are being paid the salary according to the employment contract or according to the new salary review that was done, right? Verifying social contributions. And this is where a lot of people try to skim the system. And it gets me very frustrated. Especially now with the economic crisis, a lot of companies have let go of employees. There is a market right now of employees in China looking for jobs. And companies tend to skim off of the social contributions. So either they say, oh, well, the person will be allocated in city XYZ because the social insurance rates there are minimal compared to Shanghai, okay? Or they will say, something like, the person's earning 30,000 RMB, but actually his base is 10, his social contribution is based on that 10, and the remaining amount is just a bonus. So no social insurance is required on that. You've got to work these things out properly and make sure that it's important. Most of my employees are late 30s and early to mid 40s, and social insurance, now that they're getting older, is critical for them. It's less critical for the millennials because they're healthy. They don't need these social contributions. They don't have family. They don't have kids. But as these employees get older, I have seen that it becomes a vital aspect to their compensation. And they want to make sure that they are earning the right amounts for that. Verifying that individual income tax is correctly declared and paid is also critical, and making sure that you are declaring it on the right base salary amount, and even that on the bonuses, the individual income tax is declared too. Internal procedures, just internal things like employee handbooks, operational guidelines, log books for company chops, whatever it might be, making sure you've got these internal procedures, system processes, operational guidelines in place. One guideline for the sales team will be, how do we evaluate pricing? What determines whether we give discounts or not? Do we have sole ability to give discounts, or do we have to report to a line manager if we give discounts, etc., right? Having these guidelines in place is fundamental. And then obviously, checks on your financial reports. So we're now in the peak season of looking at year-end 2020. Audits have been hopefully almost completed, and annual profits tax declarations will be due at the end of May. So, verifying your 2020 results, looking at accounting documents, vouchers, tax declarations, supporting documentation, going into the details is going to be critical. And obviously looking at your cash balance. If I can just give you a tip in terms of what I do, because looking at my financials for me is critical, is that every Friday, I want to know what my cash balance is. I want to know what receivables, payables we made in that week, and I want it in a consolidated format. Every Friday, I look at my accounts receivables. Who hasn't paid me yet? What is the aging analysis on that? Every single month, I look at the P&L. I look at the China P&L, and I also look at the accrued P&L. Again, to make sure that everything is justified. I tend to have always more questions on the China P&L because, again, it's based on the FATCA accounting. It's what's submitted to the tax bureau. And I sometimes have to remind myself on looking at the accounts receivables, knowing who's paid, not paid, and understanding why the numbers are the way the numbers are. So I tend to need more explanations on that one than I do on the accrued basis because I know what's happening on a day-to-day reflection. So for me, I look at cash balance, cash flow every Friday. I look at accounts receivable every Friday, and I look at the China P&L and the accrued P&L every month. So that's just a tip about what I do. Again, we're a service company, so it's a little bit easier than it would be if you're a trading company or manufacturing company. But you should also have those specific deadlines of when you would want to receive or read certain reports. And then also schedule in calls to have that explanation call. You know, why is whatever it is like this? What I have found is that startups, these explanation calls tend to be, or explanation meetings tend to be much longer because you are in the startup phase and you're getting used to transactions and business and you're just getting used to everything. As time goes on, these explanation meetings, because you're so familiar with the business and the numbers, it becomes a lot easier. And sometimes they take 10, 15 minutes instead of that hour and a half as it used to take. So I also want people to look at it from a time perspective. It's not as time consuming as you expect it to be when you're asking for these explanations. But if you don't have the ability to sit with an accountant who can openly explain things and you get it, and there's no communication problem, there's no transparency issue, it's important, okay? That communication aspect is critical. So make sure you're also evaluating who's in your finance team and whether you have that communication ability. So that's the end of the presentation. I'd love to hear what was your biggest takeaway from today. Again, I'm just gonna send you my contact details in the chat so that you have them. Give me 1 second. Let me open up the chat. Here are my contact details. If you guys have questions, please start inserting them into the chat box. I'm open. Nothing's popped in so far. Douglas, Irina, you're the only two that are on here today. So it's been a small audience. But if you do have anything outstanding, let me know. Douglas, I know we're talking this afternoon. And other than that, just a reminder, we've got 2 more sessions. I'm really excited about tomorrow's session because I think that will be invaluable to a lot of people. I've already got the questions lined up, all about how to manage opposing opinions, objectives between head offices and China subsidiaries. And then on Friday, we'll be looking at the 10 reasons why some businesses are not successful in the Chinese market. So if you guys haven't subscribed to that, you can go to woodburnglobal.com/events. I'll just type that in as well. And hopefully you got something out of today's presentation. I know it was quite technical, but hopefully there was some understanding behind that. I want to thank you both for joining me. And if you have any questions whatsoever, just let me know. Have a great afternoon.
Thank you, Christina. We'll be speaking this afternoon, so I'll save my questions for then. Okay.
Okay. Perfect. Thanks, Douglas.
Thank you. Bye-bye.
Bye. All right. Take care.